What if I showed you a blockchain that is currently generating more monthly revenue than Solana, Base, and Ethereum, yet is trading at all-time lows? What if I proved to you that while the price is bleeding, the actual usage of the network, specifically stablecoin transfers, has done a clean 5x in just 1 year, hitting 10 million daily transactions? Most investors are looking at the chart and screaming, dead chain. But I'm looking at the on-chain data, and I see one of the most aggressive divergences between price and value in the entire market. We have a network that is literally burning more supply than it creates, turning deflationary. We have institutional capital bridging in while everyone else is bridging out. And we have a technical setup that is sitting on the absolute final line in the sand. If this 10-cent level holds, the risk-reward is generational. If it breaks, I have a hedge strategy to short this. I'm going to show you the main distinct data points that no one is talking about, my exact entry, my invalidation level, and why I believe the market has this completely backwards. Let's be real for a second. The sentiment on Polygon is atrocious. If you spend any time on X or Reddit, the narrative is that layer 2s are fragmented, user experience is bad, and everyone is moving to Solana. Price is hovering between 11 and 12 cents. We have been stuck in a brutal descending channel since the local top at 75 cents back in 2024. We lost the mid-range of that channel, we reclaimed it, we rejected at 18 cents, and now we are back at the lows. To the average retail investor, this looks like a falling knife. They see a chart moving down and they assume the project is dying. But as sophisticated investors, we do not trade off vibes. We trade off data. And the data I'm about to show you paints a completely different picture. We are seeing a scenario where the price signal is bearish, but the fundamental signal is flashing the strongest buy alert I have seen in 2026. Why does this matter right now? Because we are at the 1618 Fibonacci extension. This is the historical floor. This is where the smart money steps in to absorb the capitulation, or where the project fails completely. I'm betting on the former, and here's the hard evidence why. Let's look at the numbers. I want to pull up the chain revenue rankings. In a recent 30-day window, Polygon generated $3.3 million in protocol revenue. I need you to understand the scale of that. That is higher than Base, which did $3.2 million. That is higher than Solana, which did $2.5 million. Everyone talks about Solana flipping Ethereum. No one talks about Polygon out-earning Solana in this specific metric. High revenue validates one thing: block space demand. People are paying to use this chain. But what are they doing? This brings me to the second data point: stablecoin transfers. According to the data from Ranksy, daily stablecoin transfers on Polygon have gone from 2 million a day to 10 million a day in the last year. That is a 5x increase. And if you look at the composition of those transfers, the blue bars on the chart are dominant. Those represent transactions under $100. This is not whales washing money to fake volume. This is actual retail payments. This is people buying coffee, paying for services, and sending remittances. This is the holy grail of crypto adoption: real-world utility. This utility is being noticed by the biggest players in the space. Tether, the issuer of USDT, recently upgraded their contract on Polygon to the native USDT 0 standard. They didn't do this for fun. They did it because there is over $1.3 billion of USDT liquidity on-chain. Tether explicitly stated there are more active USDT 0 senders on Polygon than all other chains combined. Now, let's follow the smart money. I'm looking at the net flows data from Artemis. Over the last 3 months, Polygon is ranked number 1 for net inflows, with a positive $293 million bridging over. And liquidity precedes price. When nearly $300 million moves onto a chain, it's not there to sit idle. It's there to buy assets. But here's the craziest part: the valuation disconnect. If we look at DeFi Llama, the market cap of all stablecoins on Polygon is roughly $3 billion. But the market cap of the Polygon token itself is only $1.2 billion. Think about that. The money sitting on the network is worth more than double the value of the network itself. This is a massive undervaluation signal. Usually these numbers are flipped. This tells me the token is mispriced relative to the economy it secures.
Before we get to the chart, there are 2 more pieces of the puzzle. First, the economics. Because of this massive surge in usage, the network is burning tokens at a record rate. Year to date, we have burned nearly 20 million POL, while only issuing 13 million. That means the net inflation rate is -1%. The supply is shrinking. If demand stays constant and supply shrinks, price must go up. It is basic economics. Second, the open money stack acquisition. Polygon Labs just bought CoinMe and Sequence. This gives them access to 50,000 fiat-to-crypto locations across 48 states in the US. They are building their own off-ramp.
They are bypassing the exchanges. This is a vertical integration play that no other L2 is even attempting. They are building a payments rail that connects directly to the physical world. All right, let's get to the charts. This is where we make our money. We are looking at the weekly time frame. The trend is undeniably down, but we are sitting at a critical inflection point. We are currently testing the 10 to 11 cent region. This aligns perfectly with the 1618 fib extension anchored from the June high of 16 cents to the September high of 29 cents. We have a few indicators flashing warning signs and a few giving us hope. The exponential moving averages, the 10, 21, and 55, are all overhead. The price is below them, which means momentum is bearish. We need to reclaim these to confirm any reversal. However, look at the volume profile on the left. The point of control, the price with the most volume traded, is up at 24 cents. That is a magnet. Price hates empty space. If we can stabilize here, the vacuum pullback to 24 cents is statistically probable. Now, I want to talk about the Heikinashi RSI. This indicator was at a record low, extreme oversold territory, back in December. That oversold signal led to the pump to 18 cents recently. Right now, it has curled up, reset to neutral, and is pointing down again. This is the risk. We have burned off the oversold condition without a massive price breakout. This means the bulls are running out of time. They need to step up now. So, how am I trading this? I'm a position trader. I look for asymmetric bets. I have established a load zone between 10 cents and 13 cents. I have been accumulating here, adding to my long-term bag which has a higher average cost. But I'm not a holder, I'm a trader. I have a strict invalidation level. My stop loss is a weekly close below 10 cents. This is non-negotiable. If we close a weekly candle below 10 cents, we have lost the fib support and we have made a lower low. The structure is broken. If that happens, I'll close my short-term position. But I won't just sit on my hands. I will open a hedge short, targeting the next support potentially down to the 2618 extension at 6 cents. That is how we protect capital. We flip the bias. However, as long as 10 cents holds, I'm aggressive. My take profit targets are as follows. Target 1 is 16 cents. This is the previous support that flipped to resistance. Target 2 is 20 cents. This is the 618 fib retracement level. Target 3 is 25 cents. And if we get a full reversal, I'm looking at 42 and 60 cents in the long term. I use a trailing stop strategy. If price hits 16 cents, I move my stop loss to my entry price. I'm risk-free. If price hits 20 cents, I move my stop to 16 cents. I lock in profit. Now here's the yield part. While we wait for this trade to play out, we are not just letting the token sit there. If you are risk-averse, you can stake POL natively. I'm looking at the data and the current APY is 5.3%. That's your risk-free rate. It's better than a bank account, and it compounds your position while you wait for the chart to resolve. But if you are a degenerate like me and you want to capture the volatility, look at the liquidity pools. The wrapped MATIC USDT pool on Uniswap V3 is currently paying 33% APY, and the 30-day average was over 80%. Why is the yield so high? Because of that massive volume we talked about earlier. All those stablecoin transfers generate fees, and those fees go to liquidity providers. Be careful of impermanent loss, but earning 30% yield while waiting for a double in price? That is how you compound wealth in a bear market. So, let's summarize the game plan. We have a value thesis. The network is undervalued relative to its cash flow and stablecoin liquidity. We have a momentum thesis. Institutional money is bridging in, and retail usage is hitting all-time highs. We have a technical thesis. We are at the absolute bottom of the risk curve at support. The probability of a bounce here is higher than a breakdown, strictly based on the risk-to-reward ratio. I'm risking 2 cents of downside for potentially 10 to 15 cents of upside. That is a 5-to-1 trade.
But remember the macro environment. If Bitcoin decides to dump to 80,000, Polygon will drop. That's why the stop loss is essential. I'm not married to this bag. I'm married to the setup. If the setup holds, we ride to 25 cents. If the setup fails, we short to 6 cents. Either way, we have a plan. The market is pricing Polygon like it is dead. The data proves it is more alive than ever. Opportunities like this, where the public sentiment is max fear and the on-chain reality is max growth, are rare. Do not let the boredom shake you out. Let the chart decide. If this analysis gave you a new perspective or saved you time, please hit the like button. It supports the channel and tells the algorithm you want more data and less hype. And if you aren't subscribed yet, fix that now so you don't miss the next update. If you want to track this trade in real time, see exactly when I trigger my stop loss or when I take profit, you need to be in the Telegram group. I post my charts and insights there every single day before I make a video.
The link is in the pinned comment. Now, to understand the full context of how this entire structure has played out since December, you need to watch these two videos right here. They map out the exact path we are following. Stay safe, manage your risk, my videos are never financial advice, and I'll see you tomorrow in the next one.